ignore. And so I got to tell you, I'm more with Joe. I think there's an upside surprise coming. I think that he could be, Mr. Powell could actually be more dovish. The market will like that. It pushes back the dot plot. But be that as it may, we know that the Fed has to raise rates, and it's going to raise rates. The broader economy continues to improve. We had a little bit of a hiccup here on near-term data. But be that as it may, earnings are improving, the economy is improving longer term, and the Fed has to raise rates from these crisis levels. And oh, by the way, history shows that that's a good thing for the stock market. And in fact, on the technology side, we said it last time, I think, when we were on air, 5 out of the last periods when interest rates went up, technology outperformed. And so we think that the market is in good shape. We think that the market could actually see a bit of a surprise from the Fed today. Right. And I think there's a very good chance the Fed is more dovish than you think.
All right, Joe Terranova, I'm going to begin with you today. I'm not going to ask you what the Fed's going to do because nobody really knows, and it's pretty much telegraphed. We think they're going to announce the taper at the very least. I'm going to ask you what the market can bear.
So I think you have to look at it as what's priced in. Hawkishness from the chairman, Scott, I think that's priced in.
Stocks at session highs, pretty much just off them a fraction, but still up nearly 300 points on the Dow, up nearly 2% on the Nasdaq. And Josh Brown, is this the market saying that rate hikes actually won't matter to market levels as long as it's well telegraphed?
I think maybe there's some element of that. I think a lot of people put on some hedges that maybe you're going to get unwound. Maybe there was like a minority view at the margin that there was going to be some sort of a shock or some sort of uber hawkish tone, which, I mean, for me, that would have been a very easy bet to fade. I've been saying since the summer that the taper, when it comes, will be seen as a relief.
You would be able to say, you know what, the shortages are kind of in here. The one thing, I mean, Powell is very good. He knows that this thing could end as fast as it started. He was very good, by the way, when he called the bottom, even with Omicron. Now, I know he's very smart. He's not going to claim he's a doctor, which is really good. And I just think, why can't we just say, he's doing a good job? Like, has he not done a good job? Why can't we say that? Have we created Weimar-like inflation? I don't think so.
Even though we're having Fed tightening, it's what the market wants. It's what the economy can withstand. And yet it's going to be flexible enough in that environment. And by the way, we still have a lot of liquidity, even though they're doubling the pace of the taper. Let's not think that because they're doing that, all of a sudden the rain stops falling from the sky, right? They're still doing that.
That's exactly right. He said it several times that tapering is not tightening. It's just not adding accommodation, which is different than removing accommodation, which is what rate hikes are. And I do think the market wants the Fed to be a bit of an inflation watcher, and that's very clearly stated. So if inflation is not going to track worse than expected, then the Fed doesn't have to act faster. And then if we have sort of, as you know, this looming uncertainty because of these variants and the transmissibility, that's going to create the uncertainty that keeps the Fed a little more dovish. And I think post confirmation, which is in February, we could also have a change in the character of the Fed. But at the moment, it's important for Powell to be reconfirmed.
So you're sticking with your call. I mean, that's the bottom line. 4,800 end of this year, if not even stronger, and 5,000 into the beginning of next year.
Yes.
Third, Powell will immediately be second-guessed by supposed experts who shouldn't even be allowed to shine the guy's shoes lest they get kiwi polish on his cuffs. These professional second-guessers, including professors, hedge fund managers who are short the stock market, and highly paid economists, often looking to preserve their jobs at all costs, well, they want the Fed to carpet bomb the economy in order to stamp out inflation as soon as possible. You cannot afford to listen to these people. You will never make money. You will be in your financial chains. If, like my charitable trust, they actually showed you in real time what they were doing with their money, I'm betting that they're doing somewhat of the opposite of what they say on air, because otherwise, they'd be out of business a long time ago. Fourth, there will be a pack of jackals eager to start speculating right now, tomorrow morning, about how the next Fed meeting is right around the corner, and when it arrives, Powell will have to tighten a lot tougher because inflation's still raging. These people, I say they are of zero help. I think there's actually something pathological about them, too. They can't stop talking about the next meeting. It's like they have nothing else in their lives. These people must find other hobbies. What matters in the end is that Powell's taking action to slow the economy now that he's gotten the unemployment rate back to 4.2%. I say the guy deserves a victory lap. So let me tell you, if I were in one of those squares, I don't know if you watch, you probably didn't even watch it, but there's like these big Hollywood square games of all these faces. If I would have been one, those are the press people, if I had been one of those, if I were in the audience at today's press conference, and he called on me to ask a question, me, here's my take. I would say, Chairman Powell, I want to thank you for being a person of your word, a Fed chief who cares more about the persistent downtrodden rather than persistent inflation. You correctly navigated the pandemic and are committed to continuing to do so. So thank you for not falling prey to hysterics about the various strains. You saved millions of jobs with your considered words during the downturn. You did not freak out because of strong hiring or strong spending, as it didn't require credit. And most important, you're the only non-political guy left in Washington trying to help the people who've been left behind rather than worrying about keeping your own job. So, Mr. Chairman, here's my question. Chief, what's your favorite drink? Let me say in your case, you and your family have a safe, great holiday. Thank you very much. See you next year. Here's the bottom line. The market's entering a new phase here, but as long as Powell's in charge, I think we can expect a soft landing and a lot of good stocks to find.
A little slow tonight, isn't it?
All right. Today is Thursday, December 16th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. Let's talk about market sentiment. And what about that bomb we got in the morning from the Bank of England? And lastly, Bye Stimmies. They're gone. Over. But we start with market sentiment because immediately after the algos and the pussy bears overreacted to the FOMC minutes and the conference from Jerome Powell. Yet the pumpers, of course, who have no shame whatsoever, came out of the woodwork, immediately assuming that the exaggerated and exuberant reaction from the stock market will stick, declaring victory right away prematurely. Take, for example, Jim Cramer from CNBC, who came out and said, "The Santa Claus rally might have started earlier this year. Thank you, Jerome Powell." And here was the Wall Street Journal saying, stocks close higher as investors welcome Fed decision. Did they? Or was it algos and short covering behind the reaction we saw yesterday? And here's yet another headline, a dumb headline, shall we say, that reads, "The Fed predicted inflation fighting 2022 rate hikes and stocks surged. Should consumers cheer too? How about no? Specifically when their stimmies are gone, wait for it." But the orgy continued yesterday. Here's another headline from Market Insider. The S&P 500 could soar 45% over the next year as a quote-unquote behind-the-curve Fed inflates the third stock market bubble in a century. And this is according to Stifel. And I told you right away, yes, the action was dovish. But the devil is always in the details. And the details were hawkish. Therefore, forget the knee-jerk reaction and concentrate on what he said. He said, we're not going to raise interest rates until we're done tapering. We're not going to be done tapering until March. What do we know about the stock market? It always looks forward. The stock market looks forward and it sees a cliff. And we're dumping off a cliff anything high value, high multiple growth, the future bro kind of stocks. And that, by the way, includes some of the mega cap stocks, the likes of Apple, Microsoft, with high multiples historically speaking. You want to buy the dip in the inflationary side of the market. Why? Because by kicking the can down the road and not tapering everything right away and setting a framework to raise interest rates immediately, Jerome Powell will allow inflation to go higher, at least all the way till March. And therefore, what do you buy? You buy commodities, specifically oil. And then I shared with you a few days ago that I'm starting to like gold, despite the geniuses over at YouTube and otherwise who continue to say, oh, gold is gonna crash, the upcoming crash in gold, the bear flag, yada yada yada. Well, they're wrong again, and they've been wrong all along about inflation and other things. Yet people continue to listen to these geniuses. Whatever float your boat, doesn't matter to me. But guess what? Which pop stuck today? It wasn't the tech, the data dog, the high multiple names, the ARK Invest kind of names. Those faded away quickly. What stuck is oil, commodities, metals, including gold. So folks, once in a while, you gotta listen to me. Not all the time. If you listen to me all the time, you're probably going to lose all your money, your jewelry, your car, your house, your wife, and the kids. I'll give you a clean, fresh start. No ties and no obligations whatsoever. We should start that service, by the way. Have you been searching for a new beginning? Call 1-800-TAKE MY WIFE, the kids, and the house and everything I own. Satisfaction guaranteed. We will leave you with nothing. Otherwise, you get your money back. Anyways, now the sentiment is changing after we have digested what Powell actually said. And here's the headline from Barron's. It says, why the Fed may have to kill the stock market's rally to quash inflation. You know who said that earlier this year, before everybody started talking about killing the bull to kill inflation? The guy you're listening to right now. I said, Mr. Powell, to save the economy, kill the bull. Guess what? The bull will come back. But if you wait, it's going to be too late, and you're going to end up killing both. And this is what's going to happen, by the way. When we talk about market sentiment, just so you understand that putting your blindfold on and buying the dip all the time is not going to work. You got to catch a falling knife, a nasty one. And the warning signs are right in front of you. The market breadth is awful, absolutely awful. The worst market breadth we had so far this year. It is happening right now in December. We also have havoc playing out below the surface of the market. You have the smaller cap names getting blown. The ARK Invest, high growth, high multiple, high mania names are getting detonated by the day. We're talking about over 50% losses, folks, from the top. This is all happening underneath the market. If you have lived through bubbles before, you know the first sign that the bubble is about to blow is these smaller names that led the rally higher, that led the mania. They start to blow up. But the indices, the SPY, the Qs continue to rally higher and higher and higher, because the mega caps are doing fine. And then they move from the smaller high mania names to the mid caps. When they're done with the mid caps, they're going to attack the mega caps. The Apples, the Microsoft, the Teslas, they're all going to go down. Every stock will go down to its fair value, whether you like it or not. The good news is the leadership of the market will rotate to other sectors. And if you're smart, you're going to make money either way, whether the market is up, down, or nowhere at all. The NASDAQ has been lagging the SPY. The S&P 500, yet in another sign that we are reaching the end of the cycle. In the beginning of the cycle, the mania phase of the cycle, the weaker balance sheets lead the rally higher. Because investors are not paying attention to what? Revenues, profits, that doesn't matter. It's all about the future, bro, the metaverse, the flying robot taxis, whatever. And they continue to buy these stocks, bidding them higher and higher and higher and higher. And the valuation get out of whack. And guess what? Corporate insiders dump to cash all of your money, and they crash the stock in your little head, and you're left holding the bag. When the leadership of the market rotates from the weaker balance sheets to the stronger balance sheets, as we're seeing right now, we're reaching the end of the cycle. Another sign. Mania rallies and bubbles start with the leadership of technology, communication services, consumer discretionary. These are the sectors that lead the market rally in the beginning phase. And then by the end, the cyclicals, the materials, the financials, energy specifically. Those are the sectors that lead the market higher. When we reach the end of the mania, remember 2007, which sector was leading the market before the crash? The answer is energy. And then as the market starts to crash and the Fed starts to tighten, meaning we're at the end of the cycle now, the laggards, we're talking about healthcare, consumer staples, utilities, that depends on how the 10-year is going to react, but specifically staples, healthcare, the old school names like McDonald's, for example, Coca-Cola, these are the names that tend to outperform during the end of the cycle. So what we're seeing right now, if you've been paying attention, of course, in the month of December, Which sectors of the market have been leading as of late? The answer is staples and healthcare. Yet, in another sign that we're reaching the end here. But you don't have to listen to me. You can listen to the Wall Street geniuses, the experts. And here are their expectations according to their sophisticated, fancy forecasting models. Well, the most bullish firm out there is Goldman Sachs. Goldman Sachs predicted the market next year will gain another 11.7%. The most bearish firm out there is Morgan Stanley. Morgan Stanley says the market will lose 3.7% next year. So even the most bearish firm out there is not really that bearish at all. They say the market will only lose 3.7%. Nobody says the market will crash or go down 10-20%. No firm in Wall Street. And if you thought that was a long shot, too optimistic, wait till you hear the retail crowd. Because the retail crowd, specifically the young retail investors, the Robin Hoodians and the likes, they are still in mania mode, highly optimistic, and therefore they will be the prey the predators are going to eat. They're going to be the ones holding the bag at the end. Per usual, of course. And as you can see, the expectations for market gains in the next 5 years are the highest among the young, 18 to 37. And as you start moving through the age ladder, the older they get, the less optimistic they are. They're still expecting gains, but not as much as the youth. That's number one. Number two, younger investors are twice as likely to allocate capital to high-risk investments versus the older investors. Now, what do we mean by high risk? Because this is not a surprise. The younger you are, the higher your risk tolerance. And that is the right call, by the way. You should take more risk because you are expecting higher reward. And you can afford to rebuild your reserves if you lose everything. The older you get, you cannot afford that luxury. And therefore, your risk tolerance goes down. The problem is that younger investors these days are not just taking risk by investing in high growth. Let's say Nvidia, AMD, solid companies, yes, higher multiples, higher valuations, but solid companies with real earning growth and real revenue growth. The problem this time around is they're investing in absolute garbage companies, the highest risk-taking ever. We're talking about GameStop, AMC, tulips, bankrupt companies, and this is not going to end well. Now, when we look at the distribution between cryptocurrencies and precious metals, of course, the younger you are, the more attracted you're going to be to cryptocurrencies. The older you are, the less attracted you're going to be. And therefore, I say and hereby declare that the next stage of the market is going to favor boomers. This is a boomer kind of market. Think boring stocks, dividends, high cash flow, old school names. These are the kind of names you have to start thinking about. The value kind of names. The boomer kind of names, the millennial/Gen Zer kind of investing, the Cathie Wood type of investing, that's going to be over. It's already over as the Fed starts tightening. So the best advice is think like a boomer, because the Wall Streeters, the predators, the companies, they want to prey on your ass. And therefore, they have a new buzzword that they continue to use. And this buzzword is journey. They want your investment to be a journey. Yes, we're not producing revenues or profits. The stock went down 30%, but it's a journey. You're going to continue to hodl, hodl, diamond hands forever, which is garbage, by the way. Your goal is you buy an investment at a certain price, you have a certain target, a certain goal, reach that goal, and you say goodbye. I'm not in love with any company I invest in. Matter of fact, I hate most of them, but I have a goal. I get in, I reach my goal, and I say goodbye. And we're not talking about swing trading either. I hold positions for 6, 8, 9 months, a year, 2 years, even 5 years in certain cases. It depends on the goal from the investment and the kind of stock you're investing in. And of course, it is not a surprise that retail traders are now underperforming stock pickers, aka active managers. AKA guys like me. I'm an active manager. I used to be a passive manager, and it was the most boring job I ever had. I love being an active manager because you can judge me right away. Here are my picks. Here's my portfolio. Either I'm going to beat the S&P 500 and the NASDAQ for you, and if I don't, you're going to send a bunch of wise guys to assassinate me. But the reality is, retail investors are lagging active managers by the most ever, meaning we're beating your ass. Why? Because we're picking stocks surgically and tactically and rationally. Meanwhile, you're YOLOing stocks, GameStop, AMC, tulips, garbage, the hot pick for the week, the hot pick for the day. This is not a sustainable way to make money, folks. Next, let's talk about the bomb from the Bank of England in the morning. because the expectations were, since Papa Jerome did not raise interest rates, a matter of fact, he did not taper everything right away, he kicked the can down the road, the expectations were the Bank of England, the ECB, will not raise interest rates, and they will be also dovish, at least on paper. This has probably had a lot with the market reaction today, because a lot of investors out there, a lot of market participants, were doubting Jerome Powell. Oh, he's never going to raise interest rates. The cabal of central banks will never raise interest rates. They cannot do that because they're going to blow up the economy, they're going to blow up zombie companies, yada, yada, yada. Today was a shock to the system, a jolt from the Bank of England. They actually raised interest rates higher, and I do believe that caused some panic in the market. For example, there was a tsunami of dumping of bonds. When we look at the UK 30-year bond yield, it spiked higher because all of a sudden investors started to dump aggressively. And this is an important take, by the way. The bond market can throw a fit, meaning sending a message to Jerome Powell and the Fed that, hey, if you raise interest rates, if you taper, guess what? We're going to buy bonds like crazy to push those yields on the higher end down, and thus flattening the yield curve, and thus sending a message to you, Mr. Powell, that if you do indeed tighten, you're going to push the economy into a recession. Here's the problem. Are they going to continue to be in that stance when Powell actually raises interest rates, or are they going to panic like English bond investors who played tough and then at the end of the day they dumped everything right away the moment the BOE raised interest rates higher? And of course, expectations, the betting odds for higher interest rates and more tightening are rising by the day. Why did the Bank of England act so aggressively? The answer is inflation is getting out of control. By taking action today, the BOE is forecasting that inflation will peak at 6% in the UK by April of next year. And thus the lag. When they take action today, there's going to be a lag before you see the impact on the economy. But Jerome Powell, the delusional madman that he is, he says that's old. It's different this time around because every time I talk, the market reacts right away. Wow, what a genius. We can have a janitor, literally a janitor, leading the Federal Reserve right now, and he or she will do a better job than Jerome Powell. The guy is not even qualified to be a dog catcher, let alone being the head of the Federal Reserve. And of course, UK businesses are complaining that the Bank of England is too aggressive and it's going to hit them by raising interest rates, yada, yada, yada. Well, your other choice is out of whack inflation, which will push your input cost higher and spiral wage inflation out of control, which as a result will also push inflation, overall inflation out of whack, and all in all of these wage increases will be canceled right away. Higher inflation, out of whack inflation is disastrous to any economy, and perhaps the remedy right now is indeed a recession. And of course, everybody was eyeing the ECB after the decision from the BOE, but guess what? The ECB is led by a delusional mad person, the female Jerome Powell, Madame Lagarde, who did not hike interest rates and seeks to be accommodative even as inflation surges out of whack. Lagarde said, as I said before, it is very unlikely that we will raise interest rates in the year 2022. That still stands. What does that mean? If you're in Germany, for example, prepare for hyperinflation. These delusional mad persons are going to push inflation out of whack. Now, the contrast between the Bank of England and the ECB and perhaps the BOJ, how would that factor in? That remains to be seen. Meaning, are we going to see lower inflation in Britain but higher inflation readings in Germany? That remains to be seen. In my opinion, the big dog, the largest central bank in the world, the Federal Reserve, that's what really matters. Regardless of what the ECB does or the BOE does, that doesn't matter. It's all about what the Federal Reserve does. And hence, when the US sneezes, the entire world catches AIDS. And you know, Mr. Powell says he's not going to raise interest rates. He's waiting for maximum employment. Maximum employment. That's the next trap, by the way. Well, guess what? Today we got the weekly jobless claims. They ticked a little higher, but we are still at a 52-year low. Once again, we are at a 52-year low. The initial claims were 206,000 for the week ending December 11, up 18,000 from the previous week. And the insured unemployment was 1,845,000 for the week ending December 4th. This is down 154,000 claims. So we are heading rapidly to maximum employment. Will Powell indeed follow up by raising interest rates? We'll see. The problem is, and the catch is, once he actually raises interest rates, the stock market will crash, the real estate market will crash, and the crash will spill over the economy, and we're going to start losing jobs. And somebody please pass the memo to President Joe Bananas, because this is what he tweeted today. The average number of Americans filing for unemployment over the last 4 weeks is now at the lowest level since 1969. Come on, man. When I took office, over 18 million were receiving unemployment benefits. Today, it's 2 million are. America is on the move again. What a joke. What a joke, Joe. Because guess what? Here's some bad news for Joe. You know, the de facto president of the United States right now, Senator Joe Manchin, well, he's not happy with the Build Back Better scam. He's not happy with the spending. He doesn't want his donors to pay more in taxes, of course. But he said, we've done everything that we can to help people. We cannot spend anymore. No, you've done everything to help Wall Street and maybe like 10% to help people. Some trickled down, but that's all there is. And of course, Democrats were panicking and raising the alarm due to the quote-unquote disaster of child tax credit checks ending, as Manchin signals he'll slam the brakes on passing Biden's big bill anytime soon. Senator Manchin says no more stimmies. Because you know the stimmies gotta change their shape like a Pokemon. They evolved from just a handout to a child tax credit payment. Well, that's gone now, because here's the breaking news that we got today. Because he's worried about inflation rising higher, Senator Manchin pretty much ended any hopes that the bill will pass before Christmas. Not gonna happen. Not gonna happen this year at all. And perhaps it's not gonna happen even next year. Breaking: Senate Democrats are abandoning efforts to pass President Joe Biden's $2 trillion economic agenda this year. This is yet another hit to the market and the economy. The market has been pricing in a lot of spending. All of that spending relies on stimmies. Without stimmies, the consumer is as weak as you can get. This illusion, this facade of the strong consumer, the most powerful consumer ever, right? Well, the consumer is spending like crazy to catch up with inflation. They've already exhausted their stimmies, they've exhausted their savings, and now they're sliding those credit cards up and down, up and down, up and down. Folks, we are heading into a disaster here. Can you imagine what will happen if the Fed actually raises interest rates higher? All of these credit card debts, the interest rates on that debt will go higher. Oh boy, we're heading into a massive cliff here. And folks, with that positive note out of the way, let's move on to the market coverage, starting with the performance. And here we go. The Dow Industrial Average closing in the red, down by 29.79 points, or a decline of 0.08%. The Nasdaq leading the declines today, down by 385.15 points, or a decline of 2.47%. The S&P 500 also down by 41.18 points, or a decline of 0.87%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold: materials at number 2 for the silver, financials. Number 3 for the bronze, energy. Meanwhile, the laggards of the day led by technology, consumer cyclicals, and communication services. It was an inflationary kind of theme today. Materials, financials, energy leading the day higher. What about the advance to decline ratios today? For the NYSE, 37% advancing versus 59% declining. The Nasdaq, 29% advancing versus 67% declining. The breadth is awful. It has been awful for a while. Every time we have these exaggerated numbers to the downside, we see a pop or rebound higher, at least in the futures. But you have to keep in mind that something fundamentally changed here. Moving on to commodities, what's going on here? I told you yesterday, you buy the dip in commodities, oil, and gold. And here it is. Commodities are shooting higher today, across the board. We have gains of more than 1% today for both the WTI and Brent. Likewise, gasoline prices are higher along with heating oil prices. The laggard is natural gas prices, down slightly today, but we have more good news for crude oil here. Oil prices rise as U.S. fuel demand jumps despite virus surge. So the demand remains high, and Jerome Powell told you he's going to back off until March. On top of that, Dr. Fauci came out and said, you know what? We don't need a new jab. All of this is good news regarding the thing, and therefore good for the demand of oil. We talked about the supply. The Saudis got the supply. They're going to control the supply and make sure that prices are going to continue to linger higher. On top of that, Wall Street is forecasting higher oil prices in 2022. The big takeaway, while the U.S. government forecasts predict both oil and gas prices will see a decline in 2022, many private sector forecasts show the opposite occurring. When it comes to domestically produced crude, Barclays predict that the WTI contract price will increase from the current rate of $69.62 to an average price of $77 in 2022. The bank says the Biden administration's recent release of oil from the SPR is not a sustainable way to bring down prices, and the dip we've seen in recent weeks, quote-unquote, would only be temporary. Prices could go even higher than forecast, the bank says, if the thing outbreaks are minimized and thus allow demand to grow by more than expected. Simply put, if the pandemic winds down next year, that could put more upward pressure on prices. That assessment is shared by Goldman Sachs. Oil analysts at the investment bank see upside risk, quote-unquote, that contract prices for Brent crude oil drilled offshore of Europe could climb the current price of $73 to $85 per barrel by 2023. Back to the futures, what about softs? We have gains across the board, whether we're talking about cotton, OJ, lumber, sugar, all rising higher, while we have coffee and cocoa pretty much on the flat line. Notice the rally in OJ, by the way. We spotted the reverse head and shoulder formation, and since then, OJ futures have been on fire. What about metals? A rally across the board. The dollar is down, and now we have the confirmation. Gold is up, silver up, platinum up, copper up, palladium up, everything is up. And the gains were massive for palladium futures. Massive reversal here. My hunch is the momentum that we saw today in metals will continue to go on, and therefore I am bullish gold. What about meats? We have modest gains for live cattle futures and declines of a little over half a percentage point for feeder cattle futures. On the other hand, lean hogs are rallying higher again by a little under 2% today. What about grains? A rally across the board. Soybeans up, soybean meal up, soybean oil up, corn, wheat, rough rice, all rising higher, while oats and canola pretty much closing at the flat line. And this is going to continue, folks. Instead of tapering everything right now, Powell is kicking the can down the road, allowing inflation to grow at least until March. And therefore, trader got the message, and they're betting commodity prices higher. Moving on to the big casino, the options market. What's going on here? Leading the pack at number one, the hottest table by far, is Apple, with a little over 2.5 million contracts traded hands today. About 73% of those were calls. A lot of you messaged me today asking whether the options mania, the squeeze in Apple, is over or not. The answer, simply put, it is not. They're still buying a significant amount of call options like crazy. The good news is they got slaughtered today because the useful imbeciles that they are, they want to push Apple to $3 trillion just to get the headline and jerk off to that headline. Apple is trading at $3 trillion. Well, guess what? The institutionals today decided to dump Apple because they're rotating from these mega cap names to the inflationary names to the safety names, the actual safety names, the staples, the healthcare, commodities, etc., etc. And here it is at number two, Tesla, the souffle, with a little over 750,000 contracts traded hands today. A little over 55% of those were calls. And at number three, Ford, with almost 600,000 contracts traded today. About 82% of those were calls. We still have a squeeze here in Ford. I own the stock. I don't mind it, but it is absolutely ridiculous right now. Moving on to the unusual activities that took place in the options market today, starting with the ticker SPY for the S&P 500. They're buying puts here, the 390 puts for the expiration date, January 14th, with the expectations that the S&P 500 could go down by more than 16% by then. They paid about 65 cents a piece to enter this trade. All in all, spending about $2.5 million. What about the trade for the ticker TECK for Tech Holdings? They're buying calls, the 29 calls for the expiration date, February 18th, with the expectations that the name could pop higher by more than 7% by then. They paid about $1.40 a piece to enter this trade. All in all, spending about $2 million. What about the trade for the ticker SNOW, Snowflake? They're buying calls, a lot of calls here, specifically the $350 calls for the expiration date, January 21st, with the expectations that the name could pop higher by more than 8% by then. And oh boy, they spent big bucks on this one. $14 a piece. All in all, spending about $8 million for this trade. Snowflake continues to outperform the rest of software for some reason. Is it lagging? Meaning, is it going to crash later on? Who knows? But somebody's betting the Snowflake will trade higher, not lower. What about the ticker QQQ for the NASDAQ? Triple Qs, what's going on here? They're buying puts, the 300 puts for the expiration date, February 18th, with the expectations that the Qs could crash by more than 22.5% by then, and they paid about $1.80 a piece to enter the trade, all in all, spending about $1 million. What about the ticker ARKKKGOS? For Tesla witch Kathy Wood? The bears are relentless. They're hitting Mama Kathy left and right with no mercy whatsoever, and I am loving it. In this case, they're buying puts, the 87 puts, for the expiration date, December 31st, also known as New Year Eve, with expectations that RKKK can go down by more than 5% by then. They paid about $2.60 a piece to enter this trade, all in all, spending about $1.4 million. And lastly, what about the trades? For the ticker SMH, this is the semiconductor ETF. They're buying puts here. Really interesting. And the reason is the SMH is the last man standing in the technology sector of the market. It is an offensive sector that outperforms when the outlook of growth is higher. So this is really interesting. This is a put spread, buying the 270 puts and selling the 235 puts, all for the expiration date, February 18th, with the expectations that the SMH could drop down by more than 9%, but not more than 21% by then. They paid about $7 a piece for the 270 puts, and they received about $2 a piece for the 235 puts that they sold. All in all, they spent about $5 a piece for this trade, bringing the total to about $2.2 million. Moving on to the heat map analysis, what's going on here? It is clear, today was a value rotation kind of day. It didn't matter which sector you're in, so long as your value in financials outperformed, value in technology outperformed. We're talking about IBM, names like Cisco, all of these value names outperformed. Even in communication services, Verizon, AT&T surged higher today. When we talk about healthcare, the old school, big pharma, these are the names outperforming, not the high multiple biotech names. Likewise, value in energy, industrials, materials, even defensives. The value names led the rally higher. The high multiple names, the names that surged higher as of late, we're talking about Costco, Target, matter of fact, underperformed today within the defensives. But the laggards, the good value kind of names, led the rally higher today. We will see if this is sustainable or not, but the message is clear, at least for now. Institutional investors are dumping all growth, all high valuation metrics, and they're sticking to value for now. They're even dumping the mega cap names, the so-called safety, according to the experts. Moving on to the charts analysis, starting with SPY, 30 minutes chart, what's going on here? Yesterday, we talked about revisiting 466, and this is exactly what we're doing right now. The reason is the reading on the RSI was severely overbought. We went really fast from oversold to overbought. We haven't crossed below 466, and therefore I say be careful what your assumptions are. The bears are still fighting in the ring, but today was not a clear advantage to the bears. It remains neutral because you have not crossed below 466. Matter of fact, the bears will only gain clear advantage if the SPY trades below 461. Then we're talking. Now, why do I say that? Because there are sectors in the market in the SPY specifically like energy, materials, financials, defensives, healthcare. All of these sectors are working fine. For the SPY to go down big, you need the mega caps to crash. And if you're going to short the SPY waiting for the mega caps to crash, why not just short the Qs, the NASDAQ? Therefore, I say it is still neutral for the SPY between the bulls and the bears. What about the daily chart for the continuous contract for the SPY? You can see the battle clearly here on the MACD indicator. Not sure where to cross next, up or down. You're seeing the green impressions, the red impressions on the histogram, back and forth, indicating lack of decision here, indecision. The RSI still neutral. We're seeing the volume spiking higher on the upside and the downside, and thus the battle between the bulls and the bears in the SPY. The bears will not gain advantage until the futures trade below 4,657. That didn't happen yet. Therefore, the SPY bulls still have a slight advantage. And here it is. What about the Qs? The NASDAQ 30 minutes chart. What's going on here? Unlike the SPY, the bears have a clear advantage for now in the chart of the Qs. Why? Because the chart blasted all the way to the critically important number, 397, and got rejected aggressively from that number. We went down to the support zone, and we closed the day below the support zone. And now we have to eye 379 for support. So the bears have the upper hand when it comes to the NASDAQ, not the SPY. Of course, that double bottom will be strong support for now, and therefore we have to assume that the double bottom could be a triple bottom. If that doesn't work, then we go down to 379. And here is the daily chart for the continuous contract for the NASDAQ. Unlike the SPY, the volume is surging higher on the downside, clearly. The momentum indicators remain negative on the chart of the Qs, unlike the SPY. On top of that, you have a bearish formation of a head and shoulder. And if that wasn't enough, today's candle was a reversal candle. A reversal of the reversal, and closed below 15,976. So in this chart, the bears have a clear advantage, but guess what? The bulls are not dead yet, and the reason is we have Friday. The weekly closing is the most important one. A closing above 15,976 will keep the bulls alive. A closing decisively below that number, and the bears have gained significant advantage here. What about the IWM, the Russell 2000, 30 minutes chart? What's going on here? Initially in the morning, climbed above 218, turning that from resistance into support, but that didn't last for too long. The IWM flushed down, erasing all the gains from yesterday. The good news is, the silver lining that is, the IWM closed above the support of 213, but it is just a matter of time before 213 is cracked again. Now it depends. Do we have value names in the IWM? Well, by definition, the IWM small caps is not defensive. It is not value. It is offensive, and therefore I don't see the IWM holding here either. You have to be selective, precise, surgical, tactical. If you're going to buy small caps, buy the Russell 2000 or Russell 1000 value, not growth. You have to distinguish clearly here. Be picky once again. What about the Dixie, the dollar index? What's going on here? It is flirting with losing 96 as support. Clearly, the momentum is slowing down in the dollar. We have negative divergence on the RSI, on the MACD indicator. It is just a matter of time before we see the dollar flushing down. And if that happens, it will be a confirmation that you should be long oil, you should be long commodities, you should be long gold or metals, pick whatever you like, all the way till the end of the year. And here it is, the chart of gold. And give us the Peter Schiff with the laser beam things. Here we go. Because gold is back, baby. Sexy again. Everybody assumes that this is a bear flag formation. And it was. But I told you this. Notice the behavioral element of the chart. It pierced below 1,763 and it rebounded quickly and aggressively. That is a bullish sign from a behavioral perspective of the chart. Tell me again who's on YouTube teaching you the behavioral element of the chart. Nobody. And therefore, gold is moving higher, and you have the MACD indicator crossing not the positive territory yet, but creating green impressions in the histogram, indicating that the bearish sentiment is probably topping for now, and we are witnessing the birth of the bullish sentiment. There are no guarantees here, folks. Anything could happen tomorrow. The entire market could crash tomorrow. Nobody knows that for sure. But it could happen. But we have to read the charts. We have to read the fundamentals. We have to study the mechanics and come up to conclusions day by day. And for now, gold is bullish. Because you have to remember this, gold has two enemies, major enemies. Number one, the dollar. Well, the dollar is down today. Enemy number two is the 10-year yield. It is down for now. I don't know if we're going to see what we saw with the Bank of England, with UK investors dumping bonds, pushing yields higher. I don't know if we're going to see that here. That remains to be seen. But for now, so long as the 10-year is trading down, this is good for gold, and it is not good for banks, by the way. You might have seen financials rallying today, but that could fade away quickly if the 10-year yield continues to dive down. We are in no man's land right now. The momentum indicators are strengthening, but unless we have a weekly closing above 1.5%, you cannot be bullish in this chart. And you can't be bearish either until we have a weekly closing below 1.37%. For now, we are trading in no man's land. Likewise, the TLT weekly chart, we're trading in no man's land because we don't have a decisive weekly closing above or below 149, and therefore the battle continues in the bond market. We'll see what happens. But here it is, the chart of the VIX, 4 hours chart. What's going on here? We had a little bit of a bull trap, shall we say. When we look at the MACD indicator, we saw a brief crossing creating red impressions in the histogram. And therefore, this was a bull trap. We're talking about market bulls, of course. But all in all, the action from the VIX today was positive for market bears. Why? Because the 4 hours MACD on the VIX is still showing green impressions on the histogram. The confirmation will be crossing to positive territory, meaning a reading above 0. On top of that, the VIX continues to hold on 20 as support, and if it closes the week above 20, it will be a major victory for market bears. And here is a daily chart for Apple. We have a clear, decisive reversal today. And of course, this will be confirmed if 172 is lost as support. Thank you once again from the bottom of my heart to the genius greedy morons who bid Apple higher yesterday via options. All what you have done is given me an opportunity to lower my entry cost on the puts. And now we have steak and lobster for dinner, baby, all the way till the end of the year. And the problem for Apple here is we have the RSI topping. The volume is surging to the downside, massive selling today. We have the MACD indicator on the daily about to cross, creating red impressions on the histogram, indicating the loss of the bullish momentum and the beginning of the bearish momentum in the chart. And of course, the destination is closing the gap at 165.32. We'll see how fast this will happen. It could happen as soon as tomorrow. It's a long shot, but it could happen. And that will be a decline of around 4% from where we are right now. The geniuses in the media, the pumpers, say the FAAMG trade is dead, but Apple's appeal stays alive with retail buyers and a $90 billion buyback arsenal, research firm says. Notice this, share buybacks are surging higher to push equity prices higher, granted, but so is insider trading, insider selling by executives. There is a clear correlation between share buybacks and insider dumping. This is criminal, of course, but this is your beloved system. It works this way. It's a criminal system that we call capitalism. Let's talk options here when it comes to Apple. Here are the calls for the expiration date tomorrow. Where is the maximum pain? You look at the open interest. The highest open interest, what does that mean? If it is in the money, meaning green, if you see these bars in green, that means it's in the money. What does that mean? If Apple closes above that price, the market maker is obligated to buy Apple shares at market price and hand those shares to those call options holders. This happens all the time. It is not unusual. When I look at the open interest, I see 160 as the maximum pain. If you are a market maker, you want the 160 call options holders to hold the bag tomorrow. You want them to lose, so you're not obligated to deliver all of these shares to them. We have at least or almost 70 million calls, because the number you see on the screen right now is 68,791. That's for contracts. Each contract has 100 shares, or 100 options, I should say. So I say the maximum pain for market maker is driving Apple below 160 or closer to 160 to shake out these call options holders. When we look at the puts, you gotta balance the act here. Let's say the market maker flushes Apple all the way closer to 160. Now the 160 puts are in the money. What happens if these puts expire in the money? The market maker, in this case, has to buy Apple at 160. So they have to buy the 62,381 open interest, assuming that stays the same and Apple closes below 160. The market maker will have to buy the shares at 160. It's a lot better than buying the shares at market price and delivering those shares to the call options holders, at a loss, of course. It's a long shot to drive Apple all the way down to 160, but I see this is the maximum pain point. By doing so, you make sure that the 155 and 150 puts will expire worthless. These two have a high open interest. So the balancing act here, the sweet spot for the market maker is around 160. Flush it down to 160 and then maybe pull it back higher to close it around 162, 163, even 165. That will be the sweet spot for market makers, but the maximum pain point for option holders, both calls and puts. We'll see what happens. It's a long shot, but we'll see what happens. And here's a daily chart for Tesla, the souffle. What's going on here? It is losing momentum, both in the MACD, the RSI. It is trading below 1,000. The bears have all the check marks here. It is just a matter of time before Tesla flushes down, and this could happen any moment now. We have Elon Musk on the side of bears, dumping shares. It is just a matter of time before we go back to revisit the trend line. And by the way, have you seen the doppelganger of Elon Musk, the Chinese Elon Musk, also known as Elon Musk? Of course, one of these two guys is an ambitious entrepreneur, a genius innovator who is saving humanity, and the other is Elon Musk. Anyways, moving on to tulips. What's going on here? BTC. The saucer bottom is still here. It could happen. The momentum indicators are bottoming and curling their way higher. It could happen here and we see a pop in BTC. I wouldn't touch it for now. You know my stance. I'm waiting for 42,000 on the downside or 53,200 on the upside. And lastly, here is the chart for AMC, a 1-hour chart. What's going on here? The apes have yet to climb 26 for support. You have one day tomorrow, the weekly closing. If you cannot climb 26, run for the hills, it's over. This is critically important for the apes to climb 26. It will be a psychological win, and it will give them a little bit of time to perhaps climb the stock higher to 32, 36, and get out of the trade at a better exit point. And folks, we don't have important events in the economic calendar tomorrow. We have some Fed zombies speaking, specifically Williams from New York, and this will be important because Williams is the king of doves. If he switches to Hawk, I don't think the market is going to like it. And then we have also Harker or Waller, another Fed zombie speaking, who cares? But all eyes will be on options expiration day tomorrow. The assumption is we will see the majority of the action in the morning right away, and then whatever happens in the morning, we will see the reversal throughout the day. This is the assumption, of course, no guarantees. What am I talking about? Let's say the market opens gapping down, a massive sell-off in the morning. The assumption is around 8 or 9 Pacific time, the market bottoms and starts trading higher from that point on, and vice versa. Anyhow, folks, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow, or shall we say, through the weekend. No promises here. Goodbye.